If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Shawn Winslow. Let's dive in.
Hey, Spencer, welcome to the show.
Hey, Shawn, thanks so much for having me. Really excited to be here.
Yeah, of course. And I appreciate you taking time out of your busy day to jump on. Spencer's coming all the way over from the opposite side of the coast I'm on in the Bay Area. So thanks for, what is it right there right now? Like 10 o'clock?
Yep, just a little after.
Right, nice. So good morning to you. And yeah, if you wouldn't mind just sharing with listeners who you are, your background and how you got into real estate today.
Yeah, happy to. So I am out here in kind of Silicon Valley, as a lot of folks call it. Born and raised in the Bay Area. I did actually, grow up in a real estate household, which I used to be a little bit kind of embarrassed, frankly, Shawn, to talk about, because when you grow up in the Bay Area, it's way cooler to tell your friends that you work for tech companies. And so starting as early as high school, I was like, oh, cool. So, that friend is doing an internship and that person's going to go work at X, big tech company. And I was like, maybe don't want to tell people that I work at open houses as a teenager and have to do, gopher roles for houses that need property management and all this stuff. Not quite as glamorous, but it did scare me into a 13-year career in technology companies. So I did spend 5 software companies worth of time in fintech, financial tech companies. That culminated in 2019, 5 months before the global pandemic, which we're all still kind of dealing with now, where I decided to finally leave and go full-time to manage our investing group. So I run a firm called Madison Investing, and we help professionals and independently wealthy folks just basically find and invest in vetted real estate syndications and private funds, and primarily in multifamily and self-storage, but also with a couple opportunistic non-real estate stuff. So that's a point of passion for me, Shawn. It's really something that I wish I had found personally a lot sooner. I'm
with you on that.
Yeah, it's a common story for folks like you and I, where we end up, really enthusiastic about this space for a lot of great reasons, which we'll probably get into. But I was dumping money into 401ks. I was so proud of that. I was maxing those out every year, and being like, oh, this is going to be great. And then as we had a couple kids of our own, we have, 2 boys, 7 and 4 right now. My wife, Jennifer, is also the co-founder of our company, Madison Investing. And so that all culminated with me just kind of getting the bug when I was working inside the guts of the biggest fix and flip bridge lender in the country, which when I left in 2019, we had ramped it up to the point where it was around 600 transactions per month for fix and flip loans. That was like a boot camp on real estate, more as a quote unquote adult, because I had done that early thing with my dad and only seen Brokerage. And I think at this point, it was very clear to me, I'm an operations guy. I was like leading teams probably way earlier than I should have been. At the age of 26 or 27, I had a 200 people or so under my management. And then it was just, progressively more and more challenging and broader roles at earlier stage companies, because I wanted to grow more aggressively. And so here we are. And I never in my life thought I would be waking up every day and helping people invest in private real estate deals and funds and, having a blast doing it. But man, oh man, I wish I had found it earlier.
It's amazing where life brings you, man. Same here. Like we were talking about earlier, I started off in finance. That's what I went to school for, started right out of after graduating. And if you had told me then that this is what I'd be doing now, I would not have believed you. And back then I didn't even know this was a thing, right? Like, I think like most people, it's like, you think this is for the institutional guys, the private equity, family offices, people with, decades of experience and deep pockets. And so, yeah, I wouldn't have guessed I'd be doing this, but that's how amazing life is, that you and I can jump on a call here, record this awesome podcast and share with everyone, how we've been able to do it when we didn't have that type of background. Right. And so let's get into it. How did you first get into this? What was your first deal? Like how long did it take you to kind of ramp up and get into your first, I'm assuming you're doing syndications. So how long did that take?
Yeah, correct. Yeah, that is probably the core of our business. is like syndication deals where there's one asset and you're syndicating with LPs and GPs, but then also occasionally private funds and stuff like that. And so didn't start that way. We went on a very, I hate to say it's kind of cliche, but in hindsight, yeah, kind of a cliche path where we went through, scoured the Bay Area where we live out here, where properties are insanely expensive. And this is quite a few years ago now, not 2022 pricing, but we still spent a whole summer with our infant son, our firstborn, in the car, driving around some of the broader markets, trying to find a rental. We at least understood enough. And I had gotten obsessed about investing for passive income. I got obsessed about, trying to go out and use all the resources available to invest now versus dropping stuff into a 401k account. And also, frankly, like I had banked on that same unwritten wealth plan that so many people in Silicon Valley do, Shawn, but no one really talks about it as openly. And I'll just kind of call it out because I was running this strategy and it's broken, which is you try to join an early stage tech company. You want to get in at the A series, the seed stage, the B series, early enough to have some kind of meaningful equity in what could be a quote unquote unicorn, which everyone kind of knows now is $1 billion or more valuation company. And if that becomes the next Google or the next Uber or the next major thing, that's your get out of jail free card to absolve all financial sins. And that was not necessarily panning out, as it doesn't for the vast majority of people. So I was sitting there going, okay, we got to go get some version of other income streams coming into our household because volatility is real when it's all active income. And so that is the one thing I wanted to mention before I come back to the rental is like earlier, I told you my dad was a broker and I worked in his business. And he was in the top 5 residential real estate brokers in the country for a time in the 90s. And I watched him ascend really high heights, comfortable lifestyle for our family growing up until we got hit with like a really tough 10 years of family life and stuff without going TMI, where I lost my brother to cancer, parents got divorced. Yeah, it was okay. It was a long time ago, but a lot of dominoes fell. And that one stream of income for our family that was my dad's brokerage really imploded for that time. He eventually built it back, of course, and he's just a successful guy. But I would say that was a really challenging time. And it informed me why like my path in tech and Jennifer's career in kind of consumer packaged goods and marketing leadership, something can happen to us, right? I mean, something can happen to either one of us. And that's active income. The moment that you stop working it, then it stops coming in. And so I saw all that. I saw our young kids we had in Silicon Valley kind of pace of life, me working 80 to 100 hours in an office, literally before the email at night. And it just made sense to go buy a rental. And even though we drove around all summer for step 1 of 3, this is how I kind of look at it. Phase 1, we spent $430,000 for a duplex in Vallejo, California. We still have it now. It's appreciated a lot, but I didn't know what it meant to get cash flow. And I think cash flow, a cash flow investment is not a $200 a month cash flow duplex for $430,000. That is a whiff, not a grand slam, to use the baseball analogy. And so that was learning 1. We wanted more mileage from our dollar. We looked for long distance. We finally got the courage to go and buy something outside of California, more affordable markets. So we looked at cash flow, rental properties, Midwest, South. We landed on Kansas City. We ended up buying up to 5 different properties, got same amount of cash flow a month, but $60 a month purchase price. I mean, $60,000 purchase price for $200 to $250 a month cash flow. And
nice.
Much better equation.
Yeah.
That said, no one really goes out of their way to educate you on the fact that rentals are great, but they are semi-passive.
They're not passive unless you're an LP.
Exactly right. And this is not I know some folks that are skeptics on real estate tend to hear me say that, and they're like, "Oh, that's just because you're very focused on syndications and stuff." And I'm like, wrong. And this is one of these full stop moments I have no qualms about being very direct about. There is no such thing as a passive rental, period. Mm-hmm. And if someone has one, I would love to see their processes because there are the folks who love to debate that to the core. And I'm like, man, I still plan on buying more rentals eventually, not when I have 2 young kids and not when I run a business that's very successful. It's just too much. Stuff happens. You have to manage the property manager. You still have to deal with property taxes. You still have stuff that's left on the porch and the city sends stuff to you in the mail versus sending it to the property manager. You still have to go do all these different things. So we did those. It was a headache. And then we ended up selling them eventually. And long story short, we ended up investing in our first LP multifamily deal a handful of years ago, and went well. I was skeptical, and from there, now we've been in, I think something around 34 or 35 deals. Somewhere I forgot what the cutoff is between GP and LP pure stuff, because we do both. But yeah, it's been a really remarkable, past 5 years of just kind of growth and jumping into deals. And I got very lucky connecting with some people that let me help them out on a Texas-based multifamily apartment deal of like 150 units or so, and in Dallas. And then the business kind of built around that. You tell your coworkers, you start building a network around that, and then our business evolved from there. And I never in my life thought I'd be quitting my very comfortable job in leadership and tech to go and do this as a full-time gig.
That's awesome, man. That's such an inspiring story. And like one of the points you made about, the passive part, and I like to talk about the dichotomy. I'll be like, hey, look, I own a duplex that I house hacked, and now it's just a straight rental. And then I'll look at one of my 100+ unit facilities that we have, 197 unit one. Look at those two. You would think, oh, that 197 unit has got to be so much work compared to the duplex. And it's like, no, like, yeah, it's work because I'm on the active side, but relative to that duplex, the duplex causes me way more headaches. And it's not even that it causes me a lot, but it causes me way more headaches and time out of my schedule than that 197 unit complex. It's just, people don't realize that, and then to go even further, if I was an LP on that 197 unit, like strictly just an LP, I would be even less. It would be non-existent. The only work you actually do is when you're beginning signing the PPM and the operating agreement, right?
Totally. Hey, can I add one thing to it? Real quick?
Yeah. Go ahead.
I appreciate you sharing that, because I think a lot of times folks, myself included, they come into, maybe they listen to a great podcast like this and they get skeptical right away, particularly if they come from nowhere, the real estate background. And I literally, just to give one of dozens of examples of real life stories from real people that have invested with us and, with other folks such as yourself, and they kind of see the light on the LP investing within syndications front versus rentals. I get a text just last week from a guy who was one of our earliest investors. I've known him for many years, many companies, over 10 years. Brilliant guy, doesn't need any more wealth at this point in his life. He really had to go buy that rental. He just had to. He had to do it. It was, he had already invested as an LP. He had really strong holdings in crypto and all these other things. And he had to go invest in that rental because he was like, he wanted a whole title, and I get it. I really, really get it. There's like a visceral, emotional thing. And he wanted a whole title. Lo and behold, a year later, he's dealing with title issues of his own. And still, after buying a turnkey rental, and he is not happy with the purchase. And so that's like one of countless stories, right, where I'm not saying, again, for folks listening, this isn't me preaching against rentals. It's more just, you're not investing in an ETF. You're not, and there's other ways to do the rental real estate thing, in effect, by getting distributions quarterly, monthly, and getting some appreciation out of it too, without having to go deal with that type of dynamic. And so I just wanted to share that. It's very real, but there's people that are listening to that and saying, well, I don't believe you. I'm going to prove you wrong. And to you folks, good luck.
Right. No, that's a good point. And it always comes down to what do you want in life? And I think any decision you make in life, especially when it comes to business, is, but what do you actually want your life to be? If you want to be busy and an operator of real estate, then yeah, do the rentals. But if you're investing in real estate because you like the passive nature of it, then do not buy rentals and do not become an active operator, because that's not what you're going to get. So it all comes down to what you want in life, in my opinion. But yeah, let's talk about the first deal you were actually a GP, an active investor on. Where was it? That Dallas one you're referring to? Where was it? How did you get into it, and what were your roles on that deal?
Yeah, I mean, it was really someone else's deal. They were just fortunate, like, kind enough and gracious enough to let me participate. And it was about 150 units, B-class multifamily value add project in Dallas. And so I was just honestly, involved in, basically from a learning perspective, at that point, I'd already gone through, put myself through the ringer on underwriting through a coaching program after learning hardcore underwriting on single family and rentals and stuff in my lending home career when I was at that bridge lender.
Yep.
And then, but I felt like I wanted to double down on that. So I assumed that I had already gone through all that, because I think a lot of folks tend to think like, wow, it sounds so easy. And it's like, no. What this did not include was reading 24 books in an 18-month period, listening to over 400 podcasts, and then devouring content on a daily basis, waking up from the hours of 4 to 6 a.m. before my day job to go lead teams of people at my day job that was full-time, and then taking 2 kids, putting them to sleep at home at night. That's what happened before I got into my first multifamily deal. So I just wanted to make sure not to scare people. I don't want to scare people straight here. It's just that, like, I didn't just wake up one day, similar to you, Shawn. This doesn't just manifest out of the ether. This is extremely hard work. And then I went out and found someone through heavy networking at conferences and bigger pockets, and found someone, and I was like, hey, I'd love to be able to try to learn from you guys. Can I add value and help with investors? Because the benefit is I grew up professionally inside of growth roles, operational roles, marketing, sales roles, and building infrastructure. So at least I could lend some expertise to how do you communicate? How do you build communication infrastructure? And so I helped with some stuff there, but also equity capital raising, investor relations stuff, and just, all the stuff that goes into that side of that business. And that was where I could add the most value, so that's how I helped out.
Yeah. And I'm glad you brought that up, because that's what everyone should be trying to find, like, where can you add the most value? And how Spencer did it. He found out that was where he could add value, and it allowed him to get on a deal early, which, trust me, that's where you learn the most. And people will say you learn stuff being an LP. Yeah, to a certain extent, but like, you don't really know what goes on the day-to-day of running, a syndication, running a deal like this. So to get onto that GP side is huge, because then that's when you really start learning. Where can you find value? Find someone, who's doing what you want to do, and provide them value. And more often than not, they're gonna bring you along. But so now, where you're at in your business in Madison Investing, how does that look? Are you still partnering with other sponsors? Or are you taking more of a lead role? And then I'd also love to get in how you're raising capital as well.
Yeah, happy to. I think that without getting too philosophical and heady, I will just say that one of the best things that people can do, not just in work, but in life, to position themselves for success, is to try to look in the mirror, right? Not just physically, like, is your hair done, but look in the mirror and assess your strengths, and then lean into those however you best can. And I did that exercise very thoroughly with Jennifer and I, my co-founder and my wife, because it made sense. We were not going to move to a cash flow market. And by cash flow market, to be very specific for folks and not use, a bunch of terminology, we've lived in, for example, Colorado, and we do partner on deals and buy some apartment buildings in some really great markets in Colorado. I'm always very biased towards that broader market. But we're not moving back just because we got roots here now. Our kids are in school, right? And so we had to take stock of that. And I had looked around, and I was like, well, what is a business model where I can try to still hop on planes often, go look at, be involved, like really truly meet partners face to face, but bring value in ways that I'm well positioned to do that. And so it made sense where, lots of people need a lot of help, a lot more education and handholding in meaningful ways, not just a PDF or a one pager where they read something and they're like, oh, cool, now I know how being an LP works. Like, they actually need help. They don't have 10, 12 hours to go vet these things. They don't have time and patience to go and really diligence a lot of these syndications in a very, very flooded market of stuff that all says 7% pref, 70-30 split, and a hurdle above X IRR or equity multiple is 50-50. Like, people just don't have time to do that. And so that's where we met that need, And so what we do now is we find deals and people primarily that we want to invest our own money in first. And we go and invest our own money as LPs. I fly out, meet that team, walk their portfolios. If that ends up becoming a good partnership after a couple cycles, and we put them through this long form. We really do this like long form diligence period. Then they're kind of a vetted and approved partner on in our group. And we review their deals on a case by case basis. And I'll join that team in their GP group on a deal when it makes sense and it pencils, And so it looks a little different every single time.
Right.
But when it's all said and done, we do that. And I am, as we were chatting about before I got on the call with you here today, we don't have our own unique fund for that. So it's actually very friendly to other investors that are just getting into this. It's really just making it easier to get into great deals and knowing when they are a great deal, because we already have invested our own skin in the game with these people and vetted them and gone through all these additional steps. And I can do that compliantly because I am also registered with the SEC and with FINRA. And that means that, for people who are like, I don't care about that dry technical stuff. What that means is you should, because you're investing in stuff that's a private market deal.
Yep.
And it means that we have to disclose everything about how things work, who's involved, what are the fees, how do the mechanics work, all these things. And so I digress. That was a much longer-winded answer than you.
No, that was a great answer. And I haven't heard that strategy. And I really like that. The fact that it's like an indie partnership. You don't just get married right out of the gate, right? It's like a courtship. So you putting your own skin in the game and being an LP with a prospective, operator, sponsor, that's awesome. My hat's off to you. I think more sponsors, capital raisers should do that. And yeah, listeners, like that's huge. You should want to invest with someone that is willing to, one, put their own skin in the game, but actually do due diligence with that operator, not just want to just partner with the operator at the gate just to get into deals. So my hat's off to you on that. And then
thank you.
I want to dive into the FINRA licensing, because as we were talking before and had the listeners know, I used to be licensed under FINRA, had my 766. I know how that is. And I've had someone on before who was licensed, but they worked for a brokerage where the brokerage is actually raising money to then go. The brokerage itself would invest in private placement, and then they would get a fee and a small cut of the deal. But it sounds like to me what you're doing is you're just licensing yourself, and it's held under a brokerage, because that's how it has to work. You can't just license yourself without a brokerage. So is that just for a compliance standpoint, and then you're raising money on your own and then putting that into deals? Walk us through that.
Yeah, exactly right. Yeah. And it is so rare, and you could validate, confirm or deny that, from your perspective as well, Shawn, because I don't claim to have a sampling of the entire market, but I from my perspective, across my network, it is exceedingly rare for folks within syndications and private real estate funds to go get registered. And why? It's because it's a pain in the butt for us.
and costly too, right? Especially if you had to. So now that you can do it the way you're doing it is way easier. But from the beginning, it was like, oh, I got to create my own brokerage. Well, I can't afford that. But
that's
sorry,
right.
I digress. You continue.
No. I mean, you're exactly right. And it's always refreshing to talk to someone who can appreciate the sheer volume of expense and paperwork that goes into getting to that point. Because if people knew that, they would be like, oh, I should actually feel way more comfortable with this. Because it means I'm legally required to disclose everything far more than any other sponsor. And so all that to say, we did that also because it enables flexibility. Example, when you are investing, if I'm an LP and I'm investing in, because we do this every year, we invest in a lot of deals as LPs. And if we look at a sponsor and we're thinking, okay, who else is on that GP team, right? On a very small deal, you might have just two lead sponsors, maybe two different partners within that entity. It's a really big property, and it's in a mid-market multifamily apartment building. In the vast majority of the syndications you're going to see out there that folks are kind of looking at. That's kind of what we're talking about here generally. That means you're going to probably have a pretty big number of folks that are helping on that GP team. So all that to say, like, this is really the same thing as any other deal. All that it means is really I myself have gone out of the way to deliberately hold ourselves to a higher bar of transparency. We actually take less money ourselves because we have to go pay our own fees back to the broker dealer. But it also means that we're allowed to go work on non-real estate deal stuff occasionally because there's great deals even beyond real estate sometimes too, in the private market. And so that was one of the other reasons we did this, is because we can do things like partner on a fund that we liked as like a placement agent, for example. So we invest and we can also be a placement agent. And that's a net neutral impact on the investor when they invest to us versus just going straight to the sponsor anyways, with the added benefit of they can also, pick up the phone and give me a call or set up a meeting, and I can kind of give them my expertise and however I can help and be a sounding board as to how we approach things for our own investing. So it's really hard to find good sounding boards when it comes to LP investing out there for most folks, unless you go pay to join a mastermind or you go to join like an investing club and all that stuff. So that's the kind of value we try to add. And it's pretty niche, but frankly, we have a really high repeat rate with our investors, probably because of that. I think that folks get a lot of value out of it.
Yeah, it's all about transparency and being, right with the facts up front. And so I don't have my license anymore, for listeners that are curious. Like I mentioned before, when you have a license, it's got to be held under a broker dealer. So when I left my job, generally, what happens is you have 2 years in between when you leave a brokerage to when your license, expires. So mine wasn't held for the 2 years after I left because I wasn't working for a broker dealer. So I lost them. So I don't currently have mine, but the point of this is LPs really do love transparency. And so I don't have that type of transparency in terms of, being mandated to do stuff, but we are just as transparent in the sense of we produce monthly reports, monthly financials from the property level, which show income statement, balance sheet. We do a variance report where it shows where we're at from our budgeted numbers to actual, and that's from anything from, marketing budget, the CapEx budget, all that stuff. And then on top of that, we show every bank account that's associated with the property. So you see all money coming in and out, all checks coming in and out, which our investors love. And I've realized after talking to LPs that have been in other syndications is they don't get that type of transparency. So they love investing with us for that reason. And now it makes me wonder, maybe I should get licensed to even have even more transparency. But my question to you is, I'm sure the listeners probably have the same questions when it comes to, you have a license, but there still is the syndication itself that has a exemption, private placement exemption, which is generally under Reg D, which is either 506B or 506C. But your license, does that exclude you from those rules, or do you still have to follow those rules of that exemption? And what I mean by that is, for instance, a 506B, you cannot market the deal unless it's a pre-existing substantive relationship. Do you still have to follow that even because you're licensed, or no?
I love talking about this stuff because I don't get a chance to do it as much, right? So you and I get to nerd out on it.
Yeah, right.
I love it. Really good question. I actually think that the irony is we are arguably, I would say, held to it even more. Everyone's held to it at the same standard, but ours is scrutinized at the moment of transaction. And so that would be the key difference is so the answer would be yes. We're still very much held to it. But, an example I would give would be, we previously, when we first started, we would work with even like non-accredited investors too, right? And if it's a 506B, as many folks know out there, or if they're trying to kind of wrestle with this, because it is confusing and it varies sponsor to sponsor. 506B letter of the law says you can have up to 35 non-accredited investors, as long as they are sophisticated, which is very vaguely defined. But
all that most things for the SEC. Yeah.
I will say no comment. But on a professional front, we stopped taking non-accredited, and it was that was a hard decision, man. It was a hard decision. It's not like I wanted to do that. It's because it was frankly the right thing to do, because they had to go and do so much more paperwork. There's plenty of good deals out there that they could find, but I will say this. I came from a perspective on that front, without going soapboxing on folks here, to say that like non-accredited investors in a 506B should just also take stock as to what percentage of their overall net worth they're about to go drop a 50K investment into a syndication that's a liquid for a 5-year period. So that's the kind of stuff that also makes me feel okay with it. On the other side, it's like, we are held to those higher standards. We do on 506Cs and 506Bs. And even further, there's things that we can't put in writing about marketing, like, I'm going to say the word, but I can't really dig into it further, as we talked about earlier, Shawn. IRRs, like you're talking about marketing projections, like
past performance is not indicative of future performance. Yeah,
exactly. Like the thousands of sponsored ads on Facebook, LinkedIn, Instagram, TikTok, like what have you, that say invest in my deal. I can't do that. I can't do that with a projection unless that sponsor has gone full cycle on a deal and can back that up with a comparable property.
And even people that aren't licensed are supposed to do that too, but there's a lot of bad actors out there that are not doing that. Like totally. I won't talk about a ongoing deal in terms of like performance. Like, sure, I'll show like the renovations we're doing and stuff, but I won't talk about performance until we've gone full cycle. Totally. As it should be. And also, so one of the big things that separates someone who's licensed from not licensed, being non-licensed, is that the fact that you can legally be paid for selling a security. And what that means to us, for those of us that are non-licensed, is legally you cannot be compensated to raise capital for a deal. That might be something you're tasked to do on the deal, but that cannot be what you're being compensated for. So a lot of people say, so like, what are your other tasks? Maybe you're doing some due diligence, underwriting. The common one is investor relations, which is still kind of up in the air. But I'm assuming you technically can be solely compensated for raising capital because you are licensed.
Correct. Yeah, that's correct. Yeah, which is helpful for certain deal structures as well. I mean, there's an example I would give was, there's some sponsors that we work with, and we're on our 11th deal with, and just as one example, probably the partner we work with the longest, and we did 10 of those 11 on a different structure basis, and then they wanted to set up more of a fund structure, and which is very popular in the current market context, not just only to compete, but just because there's pros and cons for each of those, right? And within that structure, it's advantageous for us to be able to still add value when we willingly decide to bake that into the deal, when we want to help our investors, provide some additional context and reporting for them, in addition to what our teammates over at the GP do. But that also means that I can just still be an LP if I want to on that fund, as Spencer Hilligoss and Jennifer Morimoto, while also acting as a placement agent if we decide to share that same deal that we liked with our group. And that's all fully disclosed, because it again, for folks, it has to be. So it's very spelled out.
No, that's awesome. I'm thinking it from like a sponsor side. That would give me a lot of relief knowing that you're licensed, because I know operators and sponsors that have gotten in trouble, or not in trouble, but they've been audited by the SEC, and it's not because of their actions. It's because of one of their co-GP's actions, who was raising money. They did a no, and everyone who's on that GP has got to get audited by the SEC because they're a part of it, and especially the lead guy, right? So from that perspective, that I can see how that would be such a relief for the lead sponsor, knowing that one of his co-GPs is licensed. So
I'd like to think so. I think that that is the most common reaction. Even when we made this change back in 2020. Gosh, it feels like yesterday, but it was like back in 2020. And I would say that overwhelmingly positive, excited responses from partners. Every once in a while, if I will say where it has been advantageous, and this might sound a little counterintuitive, is just without going long form on this, Shawn, I will say that very honored to have the dynamic changes it has for you, I'm sure, where it's like when we first got into this, you're like hustling hard and saying, please work with me, people.
Yeah.
And, now it's that flow is reversed, right? And so we feel very fortunate to have like our number one source of growth for LPs is referrals from current LPs. Our number one source of new sponsors potentially to invest in and then work with actively potentially is from other sponsors we work with. So when that happens, though, the vast majority are still very early in their firm's growth and maturity. Right. And I mean, I also have to make my business case to the broker dealer that works with us that this sponsor team is ready to deliver. And so that also facilitates an easier conversation just for me to tell them, this isn't a no, it's a let's start the right way. And I'm going to invest in your deal first if it's a fit. So this is more of a not yet,
Right.
for potential active partnerships. So I just wanted to share that because I think that
No, that's important.
Understand.
That's important. So the broker dealer that you're affiliated with, they have somewhat of an approval process or a say as who you can co-GP with.
Very much so.
Well, that's great.
We have to go through a comical number of approvals, as you can probably appreciate from your background being registered.
Yeah. Everyone and their mother CC'd on the email chain to get this approved. Yeah.
Correct.
So many eyes looking at, yeah, definitely. But that's great from an LP standpoint, knowing that there's like layers and layers of due diligence. It's not just, hey, Spencer likes Shawn, so he's going to go co-GP with him and they're going to do a deal. No, it's like not only is Spencer vetting Shawn, but his affiliated broker dealer is vetting Shawn to like the 10th degree. So from an LP standpoint, that makes a lot of sense. And that's something I'd want to see as an LP.
Yeah, me too. But I mean, real example, I'll just say quickly from the last 24 hours, we have a very confident, very intelligent and seasoned LP who's totally weirded out by it. Right. And there's kind of two camps. There's the people who have been investing in syndications and private deals for the last 20 years plus with way more gray hair than me. Mine can't see mine that well. And then there's folks who are not that. The crowd is relatively new from the last 10 years. They only look positively at this registration thing as a good thing. The old school folks are super weirded out and they're like, why do you want my information? And hey, privacy is a very important thing to me, deeply important. So I don't want to make light of anything I'm about to say. Private information, if you're talking to a guy who's worked for 5 fintech companies, including Intuit, who processes a third of the country's tax returns, I get privacy. So disclaimer provided. I think people get weirded out when they're asked for financial information. And if I ask your net worth and you're about to invest $200,000 to $500,000 as an individual in a deal, don't get weirded out because I ask your net worth. I have to make sure you have it.
Right.
Just like we're all adults here. We all invest in deals as LPs. So that's my one bone to pick.
No, I know how that is because part of our, approval process, because we do primarily 506Bs. So we still have to, create that pre-existing substantial relationship. And part of that is knowing, their finances. So we have an accredited investor form where you have to select whether you're a accredited investor or not. And if so, what's your income, or if not income, what's your net worth? And there's definitely times where it's tough to get people to fill that out because they don't want to part with that information, whether it's, they just don't want you to know So I know exactly what you mean on that. At the end of the day, it's for their benefit. Like you mentioned, like you mentioned before, it's like, if this is your last $50,000 or $100,000, I don't want it. And we need to know that, right?
Yes.
Even though
no one wins if they call you in 3 years into a 5-year hold and they're like, I need my money back now.
And it's not because I think something's going to happen to this deal. Like we do our due diligence and we provide solid deals, but one, you never know what can happen. And two, like you said, if it's their last 50K, they might need it in a couple of years. And that, that's just not a conversation either party wants to have. So
totally. Absolutely. I mean, for what it's worth, I think of that as front loading the awkwardness.
Exactly. Makes it easier for everybody. And generally those are going to be your toughest investors too, from an investor relations standpoint. The ones that are putting their last, dollars in, they're going to be calling you all the time to make sure everything's going well. So you got to weigh that too. Like, what type of life do you want to live? Do you want, not that I'm not here to be transparent with my investors. Of course I am. But at the end of the day, I've seen it where it's like, it gets to a point where it's like, can I just operate this deal? You're not like with how much you're calling, it prohibits me from doing that efficiently. And I don't want to be in a place where someone, is just so stressed out. That's not where I want to be. So.
Totally. Well, and I think that it's in the name itself, as corny as this might sound, is that, I am one of those guys who actually, I don't say no to LPs very often, but I will say that I'm the guy who won't necessarily go out of my way to make sure that we really bring that one person on board.
Right.
If it was them pushing super hard to want to make sure that I knew that I was, a customer service type role, this is a partnership.
Yep.
It's literally in the name. I'm going to work tirelessly. That's just kind of how I work. That's how we work. Investors guide literally everything that we do in terms of decisioning on deals. It's why I'm not taking a fee on one deal we're working on, for example. I'm just only doing GP equity. So we have years before we even see anything on that. And so it's essentially free for working for free right now. That's all in service of serving investors. So all that to say though, I used to build customer support centers. I used to build sales groups. And so I know what that looks like. And this ain't it. This isn't folks getting on the phone and saying, give me my reports now. This is hey, let's figure out how we can, establish a relationship and get into that relationship for a period of 5+ years. That's a half a decade, man. We're building friendships.
Right. And at the end of the day, they want to do a deal they're doing a deal because of Spencer, not because of the deal of itself. Obviously, Spencer's going to provide a rock solid deal, but they're doing it because of you, the relationship they've built with you, not the deal itself.
That I'd like to think so. Yeah, and it's what they tell us, But yeah, I appreciate you going down this tangent. We don't get to talk about this very much.
I know, right?
And I hope anyone listening understands that with the right context. I was highly defensive when I was a non-accredited investor, and I was told no.
Right.
I get it. In hindsight, I would say, good Lord, I'm glad I was. So, I just think that people need to try to do their absolute best to take the long view and find a way to go build a business or, work hard for that promotion to get to the point you're accredited and then get in a position where you're ready to invest in these types of deals. That's the next step for that person.
Awesome. Well, this has been a great conversation. Before I forget, and before I ask the last two questions, where can the listeners find you?
Yeah, I really appreciate the discussion today, Shawn. It was a lot of fun, man. So you can find us at madisoninvesting.com. And on there, you can go on and actually just book a time with me to get to know each other a little bit and just nerd out on real estate. It's a lot of fun. It's just really just us getting to know each other. So
there's nothing better than nerding out on real estate, in my opinion. All right, last two questions. First, why real estate as an investment vehicle? You can give one to three reasons why. Obviously, there's probably a plethora, and we could have an entire episode on that. But one to three, and then how has it changed your life?
Yeah, I would say lasting and longevity and demand. Demand. A lot of folks, we all stare at market cycles, right? But I would say that everyone before 2019, 2020 would ask, what happens when the world falls apart? Well, tell me about what happens when the next 2008 happens. Tell me about the next Black Swan event when it occurs. What happens when the fit hits the Shan, as it will? All that to say, we kind of had that pressure test moment and are living in it now still, right? And so it's a global pandemic, and 2008 showed that. Anyone that has a skepticism about, at least on the multifamily front, we also look at storage, and they are correlated, but I would say multifamily, people need places to live, and people need places to live. Affordability for first-time home buyers and home buyers in general. As a guy who just went in escrow on our second home ever, oh my goodness, they're expensive. And people need places to live. Apartments and multifamily and large multifamily is not going anywhere. And so that asset is very popular, both domestically as well as folks who want to invest in U.S. real estate for that reason. It's not going anywhere, man. So I wanted to share that first and foremost. I don't know if that answered your first question.
No, definitely. And a second part to it, how is it, maybe you answered this, but how has it changed your life, real estate, investing in real estate?
I think it has freed me up to look more broadly at how to add value back to other people. The first role that I play every day is one of a husband and a father. And so I try to be the best dad I can be. And everyone wants to achieve different things. I am not a guy who really cares about bragging about net worth or cares about bragging about unit count or assets under management. I truly, really, really don't care about that as much as I care about time optionality to spend time with my loved ones and be a good role model to my kids. Now, right after that, on the professional front, I want to serve people in ways that I wish I could have gone back in time and helped myself. And I look at all the folks grinding really hard in, whether it's Silicon Valley or whether it's many other office jobs, and folks who are doing that thinking this is what they're going to do until their 60s and 70s. And frankly, there's just other ways to look at wealth building. And this is a really, really critical piece of that puzzle that unfortunately, most folks are not going to find. And so I love being able to to help insert our learnings into their lives, however we can. And whether it's with us, great. If it's with someone else and they found value from a conversation that I had with them, that brings me a deep sense of fulfillment, man. And so I appreciate that too.
That's a great answer, man. I really like that. To me, it's also all about providing value and what I can do to help others, both, both teaching others how to do this, providing great investments to investors, and also just improving the lives of tenants at our properties. Like all of that, I love. It's just so rewarding. And the last one I just mentioned is probably the most rewarding, when you step on a property and people are thanking you for what you're doing, for improving it. And that's awesome.
That's incredible.
Last question, because this show is called Multifamily Money. So it's about, building wealth, creating that financial freedom through multifamily investing. But on the money side, it's also about, being smart with your money, because it's not what you make, but what you keep. So from knowing that, if you could go back in time, if you had a time machine, go back to your younger self and give yourself one piece of financial advice, what would that be?
I would, two-part. What I would do differently, this is very quick, I promise.
Not take time.
Yeah, 2009, I was living in Denver, Colorado, and I was very career focused, and I definitely bought zero real estate. So if I can go back in time, that would be number one. That had to be one of the winners for over a decade. Top appreciation for single family homes and other asset types in that market. I would have bought some of that instead of renting the coolest quote unquote apartment that I could find in downtown Denver. That was the mistake of someone in their 20s.
Yeah. Hey, I did the same thing in Boston. So
yeah,
don't feel bad.
Can't go back and change that. I think beyond that though, understanding how reasonable and achievable it is for any person out there, including myself, I would go back and say, dude, do it on nights and weekends if you need to, but start your own business. That'd be it. It's just start your own business, because everything from the tax treatment of W-2 income and a heavily bonus professional that I was for a long time with in different leadership roles, you give most of your money at first. The biggest expense is going to go to taxes. And so I would say build a business. And that is the biggest way to truly grow your capital base. And then that capital base can be used to invest in other assets. And those assets can then help you generate income, and the cycle continues. So capital engine, investing engine. Those are the two things I would go back and just be like, hey, dummy, in your 20s, go build a business. Don't be lazy.
No, I love that answer. And I'm with you. That's, like you said, I always say that tax is your biggest expense. And not that we shouldn't be paying taxes, but also be smart enough to know how to limit them, so then you can further grow your wealth, which in the long run, the more you have, the more you can give back. So it's just going to help everyone. And one of the things sorry, I'm going off on a tangent here, but when people say because we have the benefits of, bonus depreciation, other tax benefits where essentially you could pay no taxes, right? For many years. And people forget to add, you might be paying no personal tax, but all of our properties are still paying tax. And to me, that's more important, because that's at the grassroots level. Like the money is actually going to the community, whereas my income tax is going to the top of the government, and who knows where it's ending up. So I always like to add that point.
Oh, I would love to come. At some point, we got to have a whole discussion just about this topic.
We can, man. I can have you back on. Sure.
Oh, yeah. This is the really fun stuff. Yeah, I dig it. Thank you.
Well, thanks for jumping on and taking time. This was awesome. I always say these last 30 to 40 minutes, but when we have a good one, they last longer. So I'm sure this one's going to come out longer than that. So appreciate your time.
Yeah, thank you, Shawn. This was a blast, man. Really wonderful way to spend the time today. And so, looking forward to the next one.
Yeah, man. We'll definitely have you on. We've got some good synergies here. So thanks for coming on. And listeners, thanks for tuning in as always. And as we talked about today, you can make those dreams happen. And it's about building wealth to then give back, provide value to others. And that's what's the most rewarding part and fulfilling part of life, at least in my experience. And it sounds like the same with Spencer's. So everybody get after it, and we'll catch you on the next one.
Hey, this is Shawn Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course share it with a friend who needs it. See you next week for another great show.